Welcome to another episode. On this one, I'll be discussing about the 15 key financial and economic terms. This is particularly for engineers because during discussions with any of the engineers, I find that they don't have much knowledge on certain financial terms, particularly those who are coming out of the college. And if they got to go into an MBA degree, and then probably they will understand the financial terms better. So that's where I thought of giving the key definition part and trying to give with an example so that the understanding could be better in financial terms. However, having said that, it is too difficult, to cover everything in detail because it's a vast subject, but I'm trying to do as much as justice as possible to describe them by the definitions of each one of them. So it's not only for engineers, but for anyone who wants to know the basic and key financial and economic terms. So let's get started. The first one, as far as the financials is concerned, is the equity. Equity in the sense, assume you want to start a business. Then equity is your own funds. Whether it's even a retail shop you want to open, generally a small shop, then you invest your own funds. So your own funds, or it's called the capital, and that is called the equity. It's termed as equity, particularly in case of a public limited company, then it is called the shareholders fund. So it is termed as equity. Ideally, think of it as a your own funds. That is where in even the share market mutual funds, they refer equity funds or debt funds. So equity, think of your own funds. In case of proprietary partnership concern, it is called as capital, and in case of public and private limited company, it's called the shareholders fund, which is termed as equity. And then comes the debt. Debt is something like you do borrowing or loans, is known as the debt. Then comes the assets. Asset is something you value to a person or a company which owns it. Example could be the cash at hand, whatever you have it on your hand, or it could be in the bank. Land, building, car, machineries, those are asset because they have a value for it. Even if it is after 3-4 years, your car has a value. The machinery has a value, but though the value would have reduced, we'll see what is the term for that. Still it has a value. So then in that case, it is called an asset. Then comes the liability, which is an obligation to pay at a later date. You get something on a credit, you are liable to pay for it. You get something on credit, meaning you say that I'm going to purchase this, but I pay it later through EMI or whatever, but then you are liable or you have an obligation to pay. So those are called the liabilities. So example, debt, pay for purchase on credit because you get it on a credit, 90 days credit, 30 days credit, or 1 week credit, but then you are bound to pay for it. So that is called the liability. So these are uh, some of the key terms as far as the business is concerned. So, but even for a normal person, you need to understand what is an asset, what is a liability, and what is equity, and what is debt as well. So with this example, I hope it's clear. And now you need to maintain this, as if it is a company, you need to maintain this in a book of accounts, and that is a called the double entry system. Double entry system of accounting or bookkeeping means that every business transaction amount must be recorded in a minimum of 2 accounts. So that is where debit credit comes into picture. There are various rules, but I'm not going into the rules. But generally, a debit is an accounting entry that increases an asset or expense account and decreases liability or equity account. So increases the asset when you purchase, as far as if it's a company, if you purchase, then the machinery account is debited. And similarly, a credit is an accounting entry that either increases liability or equity account and decreases an asset or expenses account. So just one example, suppose if you are a company and if you are purchasing machinery from a supplier for cash, then debit the machinery account because it's increased the asset. So debit that account and credit the cash account. So the cash account goes outside, so you credit the cash account. So you will have a double entry system, and at the end of the day, then you get into the trial balance. But have an understanding what is a debit, and you have a credit entry. Has to be matching credit entry needs to be done in your those are called the journal entries, and then it is also termed as ledger, entry, and then you generate the financial statements. So there are rules for it, but I am not going into the rules of it, but you need to understand because the accounting itself, subject itself is a vast subject. I'm not getting into the details of it. So now the next one is depreciation. This is very important because what you procure today as machinery is not the same. Say for example, if you're procuring a car today for INR 10 lakhs of rupees, then after 3-4 years you cannot sell it at 10 lakhs, you might need to sell it for 5 lakhs. So why? Because value gets reduced. But whereas it's quite opposite with something like gold or something like your land as well, real estate land as well, the value is said to increase, but whereas building gets depreciated. So reduction in a value of the asset over the time due to a particular wear and tear, that is depreciation. So treated as an operating expense because you reduce it, the value of the asset in the book of accounts. However, though you reduce it, there is no cash outflow there as far as depreciation, because you don't pay anyone, you only reduce the value. There are different methods of depreciation, some of them like straight line method. There are different formulas to calculate the depreciation from the accounting perspective. I'm not going into that as well. So end of the day, you need to have this or record it on the financial statements. So record that provides information about the financial performance of the company is known as the financial statement. So if you look at it, there are trial balance, you have all this and you come out with the trial balance, and then profit and loss statement, and then balance sheet as well. You produce the balance sheet as well. So this is the way it goes: trial balance to profit loss account, balance sheet. There is something like cash flow. Those statements are called the financial statements as well. Now let's look at some of the key economic terms. The first one is of course inflation. You will keep hearing inflation. So inflation is something like year on year basis. There is going to be the cost is, you will see that whatever you procure today, 1 year down the line the cost would have increased. So the reason is the inflation. Inflation is an increase in the general price of goods and service in the economy. Generally it varies from 1 to 10% in a country, generally, but it goes beyond something like 20%, then it's called a hyper inflation, which is not good for the country. Up to max of 10% is okay for any country, but lower is the better. Anything beyond 5 also they say it's not good, but again that depends on the GDP. So then comes what is GDP. So gross domestic product is a total monetary market value of finished goods and services produced within country borders in a specific time period. So GDP year on year basis, they will say it has increased by 5%, 7%, and when there is something like pandemic, most of the country had negative GDP because there was no production at all for 3-4 months, and there was even low output, people didn't procure many of the goods, particularly capital goods, car sales or any of the appliance sales was negative. So during pandemic it was negative, but otherwise it is noted in percentage. So let's look at different countries. This is as of 2022 US inflation. After, they say, after 30 years inflation is so very high in US, 5 to 6%, GDP is about 2%. So if you note this one, it is twice, inflation is twice that of GDP, and they say that's actually that is not good. It's not that they say, but generally it's not good. When inflation is more than the GDP, is not good for any country. Then China, if you look, it is 2022. Again, this is 2022. So it's almost same, 3.3. And if you look at India, it's 4.5 inflation and GDP growth is up to 6 to 7%, which is said to be best as of 22-23, and even World Bank or IMF has indicated India as a bright spot in as far as the economy is concerned. So inflation and GDP is a key term as far as the economic terminology is concerned. And then fiscal policy, it is something related to the government, how they spend, what is the taxation. So because a country has to have a revenue and it needs to spend out for the welfare scheme. So simply put, it is a policy of government spending and taxation to achieve a sustainable growth. So fiscal policy. Then comes the fiscal deficit. There is a difference between the total revenue and total expenditure. Government is termed as a fiscal deficit. It is an indication of total borrowing needed by the government, because when it is, particularly when it is negative, because total expenditure is more than the total revenue, then it becomes a fiscal deficit, and that's where you need to borrow or print currencies. Countries like most of the countries do the print currencies. When you print the currency, the problem is it gets into the inflation track. Inflation is going to go when you do a printing of currency. So while calculating the total revenue, borrowing is not included. Fiscal deficit is the expenditure is more than total revenue. Then you need to look out the ways for reducing it through either through borrowing or through printing currency. So balance of payment, that is between known as the import export. So the which one is more? So that is what is the balance of payment. And then comes, if you look at it, this is regarding the stock market. Bull market, when the stock market is rising, then it is called a bull market. You will see that sometimes stock market booms, it keeps rising, then it is termed as the bull market. Bear market is something when the economy happens, when the economy is receding with majority experiencing values in decline, then it is termed as a bear market. When it is the stock market falls, then it is termed as the bear market. So these are the key terms. This is not the entire, you can't, difficult to understand entire thing in just less than 15 minutes. But you can, based on this, you can do further research if you are really interested. But this is from a definition perspective. I hope you had an understanding of the different financial terms and economic terms. So thank you for tuning in, and do subscribe to my channel. Thank you.